Are you looking for ways that you can save on your monthly mortgage payment? A lot of people are right now. Everything's crazy expensive. Hi, I'm Amanda Ray with Guild Mortgage. Today I want to talk about a few strategies to help you lower your monthly mortgage payment. Here's the first strategy. It's called financed mortgage insurance. Everybody thinks that if you put less than 20% down, you have to pay mortgage insurance every month, and everyone thinks that that could be hundreds of extra dollars a month on their mortgage payment. One really cool thing that you can do is you can pay your mortgage insurance as a lump sum. You can add that lump sum onto your mortgage so that you're not having to pay it every single month. That's gonna save you on your monthly payment. A second strategy that everybody's talking about right now is called a temporary buy down. It's where you use a seller's money or your lender's money to temporarily buy down your interest rate. The first year of your mortgage, your interest rate is 2 or 3% lower. That's hundreds of dollars a month. The second year of your mortgage, your interest rate is also 1 or 2% lower, which is hundreds of more dollars every single month. I ran a scenario for a client, and by doing this 3-2-1 temporary buy down, they were gonna save $28,000. $28,000 on their mortgage in the first 3 years. That's a lot of money. A third strategy to lower your monthly mortgage payment is a permanent buy down. What if you don't want that temporary buy down where your mortgage payment's only lower for the first couple years? You can use the seller's money because right now we're seeing seller incentives. When you look online and you see price reductions, that usually tells you that a seller will give you a closing cost credit, which you can use to permanently buy down your interest rate for the life of the loan. If you do that math over 30 years, that's gonna be a lot of money. A fourth strategy to lower your monthly mortgage payment is called a hybrid ARM. A hybrid ARM is different than a traditional adjustable rate mortgage because there's a fixed period. If it's a 5-1 ARM, it's fixed for the first 5 years. If it's a 7-1 ARM, your mortgage is fixed for the first 7 years. If it's a 10-1 ARM, it's fixed for the first 10 years. Those hybrid ARMs, they have lower interest rates starting out than a fixed rate mortgage does. Lower interest rate, lower monthly payment. And then a fifth strategy is called a debt consolidation strategy. In this scenario, you're going to sell your house, you're gonna take that equity, pay off your debt, use the difference, you're gonna buy a different house, and then instead of having a mortgage, plus a car, plus credit cards, plus student loans, plus your side-by-side, you're gonna pay all that stuff off and you're just gonna have a mortgage payment. If you don't already own a house, you can do that same debt consolidation strategy. Some people that I talk to, they might be thinking of, say, putting 20% down on their new mortgage. Well, in a lot of times, we can have them put less money down. Say they put 10% down instead of 20% down. They use that other 10% to wipe out the rest of their debts. Yes, their mortgage payment might be a little bit higher by putting 10% down instead of 20% down, but when they knock out all of those other debts, it actually ends up to where they're paying less every month than they would have if they had debt plus a mortgage with 20% down. So those are 5 ways. I have more. I'd love to talk to you about all the different ways that you can save on your monthly mortgage payment every single month. I'm Amanda with Guild Mortgage. I do business in Nevada and California, and I'd love to be a resource for you.